All right, everyone. Thanks for joining. So we'll be going through our weekly Call the Underwriter client onboarding call. So what I would like to do here is just kind of give an overview of a little bit on how to put together a seller finance deal, and then how to work with Call the Underwriter, and kind of what our processes are and what to expect when you engage with us to underwrite one of your deals. So Call the Underwriter has been around for several years now. I'm not the original owner. I picked it up about 18 months ago, but we provide RMLO services for investors in all 50 states. And we do hundreds of loans every year. We've probably seen more seller finance loans than anyone else out there. I'm willing to wager. Relatively small team. There's three of us at the moment, myself and two other underwriters that'll probably be expanding throughout 2026. But we're primarily providing underwriting and compliance services for people who are originating seller finance loans for owner occupied borrowers. We also have the ability to produce loan documents and closing packages across all 50 states. And then we have some other individual services we offer. But basically, we're working with primarily real estate investors and the ones who are really focused on creating really high quality, near bank grade loans. So, what to think about when creating a loan? Sometimes people come to us and they're very concerned about the compliance, which is obviously very important. But I would urge you first to think about what kind of borrower you have and how to make the most solid, high quality loan, right? So, one of the things we help people with is making sure their borrower is credit worthy, and then also making sure that your borrower can afford the loan. Where the compliance stuff comes into play, like in general, the compliance bar for Dodd-Frank is relatively low. But when you have a compliant loan, what it really does for you most of all is it gives you a really valuable asset. So if you ever decide to sell the loan, sell a partial in the loan, borrow against the loan, having a compliant loan allows you to deal with banks. And when you deal with banks, they're going to tend to be the easiest to work with versus dealing with an individual. And they're going to pay top dollar for that as well. And then the other place compliance really comes into play would be enforceability. So, God forbid your borrower does default and you end up in court and the borrower decides to fight you. Should the borrower try to claim that you didn't follow the consumer rules or you did something predatory or something like that, well, then you're going to have the full underwriting package that you'll show to everyone, and that basically snuffs any kind of enforceability concern. So just a real high level overview on compliance is something I could give like a 2-day workshop on, honestly. But the things that are like most important that you really need to know when you're creating a loan are, okay, number one, the rules for owner occupied loans kick in when a default means someone can lose their primary residence, right? So these rules that we're talking about here, this is different than hard money lending, other kinds of investor loans. But when you're talking about owner occupied loans, that's where we get into a different rule book. The other kind of thing to point out too is that, typically when people are doing investor transactions, right, it's very buyer beware. When you're dealing with consumers, it's not a buyer beware world, right? So even if your borrower is willing to sign up for something that's not in their best interest, you can still get in trouble, even if you both agree. There's a host of different laws on the books that come into play, but kind of the main ones to think about are Dodd-Frank, which basically just means you need to validate that your borrower has the ability to make payments on the loan, right? Which you should want to do anyways. And then there's TRID, which means that there's a lot that goes into that, but basically you need to send a loan estimate to your borrower 7 business days before you close, and a closing disclosure 3 business days before you close. So the idea there is borrowers have the opportunity to read all the fine print if they want to well before closing. They're not getting changes tossed at them at the closing table at the last minute. And then there's also some other limits on upfront fees you can charge, or ongoing fees. There's limits on late fees and different things. There's a host of different minutia that we help investors with. So for TRID, which is, like I said, it's a big complicated thing. It's actually acronym of acronyms. So it's from the Taylor-Respra Integrated Disclosure Rule. And so this just means you need to send those disclosures out ahead of time. It's something that's required by the CFPB. And it does apply to all consumer mortgage loans, whether it's, including seller finance, whether it's a traditional mortgage deed of trust or land contract or whatever. And then it also defines rules where you might have to resend disclosures if certain fees change during the process. And really, the whole purpose of this is just that everything is very transparent with the borrower. They know what they're getting, they know what they're paying, they're not getting surprises, right? Which those, having both parties to a transaction on the same page just benefits everyone and actually reduces your foreclosure rate. And so at the end of the day, like my take from spending the last couple of years, like really, really nerding out on this stuff is that at the end of the day, all these compliance rules that some people are kind of afraid of are really just telling me to do things that I want to do as an investor anyways, and that are in my best interest, right? If I'm making a loan and I expect to collect payments, I want to know the borrower can afford to make payments. I want to be on the same page as the borrower so we don't have any kind of confusion over what the terms are or how this thing is going to work. Okay, so our RMLO process, so I'll talk about this a little bit and then I'll zoom out to kind of the overall flow of putting together a seller finance deal. But our process starts when you submit a term sheet to us. So there's a link on the Call The Underwriter website for that. We get the term sheet, then we'll reach out to your borrower, we'll collect their application, authorization to pull credit, and income docs. Once we get through all of that, we'll go through our actual loan underwriting process. And then we'll generate the TRID disclosures, the loan estimate and closing disclosure. And then at the end of the process, we'll send you the final package that has all the data that we either collected or generated throughout the process. For people who haven't done seller finance deals before, we at Call The Underwriter do one piece of it, right? But there are other vendors you'll need as well. So when you're finding a buyer, you can work through an agent, or sometimes people will do it through Facebook Marketplace, Craigslist, or all of the above. And then once you found your borrower and you've pre-screened them and you've agreed to terms, that's when you'll engage with us. We have an RMLO. So if you're doing a loan with an owner occupied borrower, you're going to need an RMLO to handle all of the compliance and underwriting work. The good thing about it is you can pass the cost on to the borrower, right? So you can add that underwriting cost as a closing cost to the borrower. So basically, the lender will have to pay us because we work on behalf of lenders. And so you float that cost for a little bit, but then get paid back at the end. I also recommend closing through a title company. You don't absolutely have to, but I think it's a best practice. Also, not a terrible idea to have a real estate attorney involved to review everything, especially if you're doing a more creative type deal. If you're doing like wrap loans and sub twos and that kind of stuff, or lease options, things like that. Oftentimes, there are very state specific rules around how those need to work or specific disclosures. So it's good to have a real estate attorney. And then after you've created the loan, you're going to want to have it boarded with a licensed loan servicer. So that loan servicer is going to send statements to your borrower, collect payments, keep track of the amortization table. They're going to help you in the event that the loan does default. And just like with the RMLO work, you can pass that monthly loan servicing cost on to the borrower. So, and there's also a lot of compliance in the ongoing servicing that's actually more intense than in the origination. So the good thing about handling compliance on the upfront origination and the ongoing servicing is it's basically free to you as long as you disclose that to your borrower up front and bake that into the deal. So you don't have to pay for any of that. And then you don't have to, but some people engage with a transaction coordinator, especially with the more complex creative deals. And then on the Call The Underwriter website, we've got a page with some of the vendors that we work with. We work with many more than that, but we just list like starting points if you're doing this for the first time. Okay, so the overall transaction, this is my eye chart, right? It's actually not quite as complicated, I think, as I'm making it look here. So for you, you're the investor slash seller slash lender, right? You're going to find your buyer either through an agent or on your own or however. Once you find your buyer, you're going to want to pre-screen them. And that's just a short conversation to make sure that they can document their income. They don't have like active foreclosures or bankruptcies, other kinds of red flag things that are going to disqualify them from being able to get a compliant loan. So once you've got your borrower, you've done some initial vetting, you've agreed to your terms, so your sale price, loan terms, etc. You could be under contract at this point or not. Most people are, it's not required. But at that point, then you'll be ready to engage with us. You'll submit the term sheet form. There's a link on the Call the Underwriter website. We'll reach out to the borrower and get all their docs that we need. So their loan application, credit authorization, income docs. Once we have that, we go through the underwriting process, and then we'll generate a draft loan estimate, the 1008, which is the official underwriting form. And then we'll send that to you, the lender, to review first. And we'll have with that our recommendations on how to proceed. And it's also an opportunity to make any corrections. Sometimes things change between when the term sheet was submitted and we get to the loan estimate, or maybe there's something somebody didn't put in right on the term sheet or whatever. So once you've approved that, we'll make any corrections needed and then send it to the borrower. Once we send it to the borrower, that starts the 7 business day TRID clock. And then we'll later follow up with the closing disclosure. And then with the closing disclosure, sometimes people use ours or they have it generated by the title company. It depends. And then at the end of the day, we'll deliver the final package. We're generally not directly involved with the actual detailed closing, unless sometimes when we're preparing the loan documents themselves. So timelines that are important, it's generally a good idea to plan to get us the term sheet and start it at least 2 weeks before you close. And the reason for that is it generally takes a couple days for the borrower to get all their information to us. Once we have everything, it's about 1 to 2 business days typically for us to do the underwriting, just depending on how complex or simple the file is and what's in our queue at the time. And then you've got to review the loan estimate. And then once we get that out, there's 7 business days for TRID. So you figure a couple days for borrower docs, a couple days for underwriting, 7 business days, maybe a Sunday, maybe a holiday. That 2 weeks goes pretty quick, all in all. Sometimes people come to us and they're on a Tuesday and they're like, "Hey, I'm closing Friday." You're not going to be able to do that compliantly because you're going to have the 7 business day window for TRID. And then when you submit the term sheet to us, if you're new to us, if you haven't done one with us before, you'll get an email with a link to fill out a client acknowledgement. And what this does is it just kind of outlines a lot of the policies and procedures that actually I'm talking about in this presentation. And so that just makes sure that we're on the same page and you know what to expect as far as how the process flow is going to work, when you're going to get invoices, when to expect different things. And then talking a little bit about our underwriting process. So this starts once we get everything from the borrower. We can't start this till we get everything in. And what we're going to do is we're going to go through their pay information. We're going to calculate their usable monthly income. We're going to do a soft credit pull. It gives us the same data as a hard credit pull. But that's going to give us not just their credit score, any credit blemishes like collection accounts or recent inquiries. It's also going to show their other monthly debt obligations, right? So if they have auto loans, student debt, credit card payments, installment loans, etc., we'll get that, which we'll be able to roll into their total debt to income ratio, right? So once we have all that information, we know the PITI on the new loan because you gave us that on the term sheet. We know their other monthly debt payments from the credit report. And then we've determined their gross monthly income based on the income documentation that they've provided to us. We're also going to create any loan conditions that may exist. So loan conditions are things that we recommend having the borrower clear before you close. Now, depending on what the loan condition is, the lender can choose to waive them in many cases, but these are things we recommend clearing up to create the cleanest possible file and the most valuable possible loan. So if they've got accounts on credit report that are in collections, we'll ask that they either be brought current or show that they put a payment plan in place with the lender. If the borrower's credit score is below 620, then we'll add a condition to get a verification of rent. And so that's just a way of mitigating a lower credit score, because there's some borrowers who have lower credit scores, they have credit blemishes, but maybe they always make their housing payments on time. So that's a way of documenting that. If they have deferred student loans, which is very common, you don't want to have a scenario where the borrower meets debt to income requirements and can afford the loan because their student loans are deferred, and then the deferment period ends and student loan payments kick in, and all of a sudden they can't afford the property. So we may ask them to go into their student loan account and calculate what their anticipated payments are when the deferment period ends. Answer any recent credit inquiries, or sometimes we're just missing information, things like that. The way we determine monthly income, so across the mortgage industry, gross monthly income is what's used. And so for W-2 employees, it's pretty simple. We just need to get their 2 most recent pay stub and a copy of last year's W-2. If they're self-employed, which is probably the majority of seller finance borrowers, it's a little more involved. We'll typically need to get their 12 most recent bank statements showing all of their business activity. And what we'll do is we'll take the average of the deposits from their business revenue, but then to get their actual income level, we'll apply an expense ratio, right? So that expense ratio will depend on the type of business that they have. So if they're just like a consultant type person, well, their expenses might be very low. If it's a contractor that has a bunch of employees and a crew and a bunch of equipment, it might be much higher, right? And then if they have like a fixed monthly income through Social Security, VA benefits, disability, that kind of thing, that's super simple. We just need to get the award level and then, or the award letter. And then in that case, we actually tend to plus up the income because they're typically not paying income tax on that. So the equivalent gross income would actually be a little bit higher than what those letters show. And then once we've gone through that process, we'll generate a draft of the loan estimate and we'll send it to the investor with the 1008, which is the underwriting form that has the underwriting comments and everything, shows the debt to income ratio, a copy of the credit report, and then all the loan conditions we recommend to review. So once you've reviewed that and approved it, we'll send it to the borrower. We'll email it to the borrower and copy you, and then we'll also send it to them to e-sign, and that starts the 7 business day clock for TRID. Now, the way that you count the days, this can be a little confusing, and don't worry, you don't have to know this. We can just tell you, and our software just tells us this. But basically, Saturday counts as a business day. Sundays, federal holidays don't. You don't count the day that the loan estimate gets delivered to the borrower. And also, these dates are based on when it's delivered to the borrower, not when they sign. Borrowers aren't technically required to sign. We have them do it just because it removes all doubt that they had it then. And then the closing day does count. So like, let's say we're talking about the 3 business day waiting period for the closing disclosure. So today's Thursday. So if we were to send out a closing disclosure today, Thursday's day 0, Friday's day 1, Saturday's day 2, Sunday doesn't count. Monday would be day 3, and then you can also close on that day. So if a closing disclosure went out today, that would mean that you could close Monday. And then the closing disclosure, so we'll send out the loan estimate. We'll follow up in a business day or 2 with the CD, and we'll just send that to the lender initially. So the reason we just send it to the lender initially is most of the time, you can use our CD if you want, but a lot of times people will use a CD from their title company or attorney that has all of the detailed recording and other costs associated with it. Sometimes they want us to rebalance the CD. So sometimes we'll send the CD to you, send it to the title company, and then the title company comes back with all the detailed final fees, and then we can update our CD and balance it with the final numbers from the title company. The only thing I emphasize, though, is that we've had some title companies who send us 10 different revisions. We're not really equipped to do revision after revision at the last minute. So we just ask that they kind of wait till they have the final numbers, send it to us, so that we can do it once. If we start getting into a bajillion revisions, then we do have additional fees to spin those. And we also can't balance against HUD ones. So it's just a different format. And so title companies have never had a problem either redlining our CD with the fees or sending us their fees in a CD format, and then we can update ours. And then when we're all done, we'll send you a zip file with everything that we've generated during the process. So copies of disclosures, the 1008. We will create an ability to repay cert, which is basically just a statement from us saying that we've reviewed the file and we feel that it meets Dodd-Frank requirements. And then copies of the loan application credit report, the raw income data, everything that's come through. And so we will email you the zip file. You'll want to hang on to that in case you ever need it later or decide to sell the loan. But we never delete, we archive all of our data. So for some reason, you get 3 years down the line and you need the file and you can't find it, just let us know and we'll get you another copy of it. So the way the pricing works is our RMLO service is a flat $7.99 fee, and we invoice it in 2 stages. So when you submit the term sheet, you'll get an initial invoice for $199. And then when you've approved the LE, you'll get an invoice for the remaining $600. The reason we break it into 2 stages is sometimes, even if you've pre-screened well, borrowers don't work out. So if you have a borrower that doesn't work out, you're only out the $199 and not the entire $799. But then it also leaves an incentive for lenders to pre-screen their borrowers, right? So when files come to us, there needs to have been some initial pre-screen of the lender. We don't really sift among multiple borrowers to find the right borrower. Once you found your borrower, then we go through and thoroughly vet them. And then one thing to call out too is because rules on invoicing and non-refundable fees in the mortgage world are very different than what they are in the say rental world. Because we work on behalf of lenders and we don't work on behalf of consumers, we can't legally invoice the borrower directly. So we send the invoice to the lender pays us, and then the lender gets reimbursed by the borrower when they close, right? So, and then if you are having us prepare the actual loan docs, the mortgage deed of trust and closing package, then we have an additional $595 fee. We can do that as well. You can also get those from your title company, attorney, etc. So when the $199 fee goes out, so we'll need that paid before we start work on the file after we get everything from the borrower. And then we'll send the second invoice when you've approved the LE, and then we've sent it to the borrower, but we will need that paid before we continue on with the closing and disclosure and final package. We do have a number of payment options. You can do credit card or ACH. We also have the ability to turn on PayPal if you want to do that as well. And then if you want to have us prepare the loan documents and closing package, we work with a vendor called DocMagic, so we can create loan docs compliantly in all 50 states, even the attorney states. These are for residential loans. If it's a commercial loan, that's a different ball game. We can't do them if it's a wrap loan, just because some states have specific disclosure requirements that our vendor's not set up to handle. We also can't do loan docs on chattel loans. So we underwrite mobile home loans all day long. So if you need us to underwrite a mobile home loan, we do a lot of those. Or if it's a manufactured home connected to land, we can do land docs for those. But if it's just a pure mobile home loan, which is like an auto loan, we can't do the loan docs for that. And then also we're licensed brokers in Texas, Florida, and Colorado. So sometimes investors are doing seller finance because that's the best way for them to sell a property. Sometimes if a property is lower dollar value, or they just have a self-employed borrower, banks don't like to deal with them. But there's an increase. We work with a number of wholesale lenders who offer non-QM loans that often fit the same borrower profiles as seller finance. So if you're potentially interested in having your borrower get financed by someone else, or you basically want to get paid in cash, if you have a property in these states, let us know, and we can often work with our wholesale partners to get them loans as well. We can also do DSCR loans and other kinds of things in those states. So if you need additional help, there's a lot of information on our website. There's a full pre-screening guide. There's also that investor guide and vendor list that I mentioned about. You're always welcome to attend another one of these weekly calls. We do them on Thursdays at noon, and the link to register is on the Call the Underwriter website. Or if you just have a general question, always drop us an email at team@calltheunderwriter.com. And then we got more information on our YouTube channel that'll be expanding before too long. And then if you want a training course, there's a link. Fred and Tracy Ruby have a good course on seller finance, and there's a link to that on the Call the Underwriter website as well. So thanks for joining. That's what I've got for you today, and I'll stop the recording now and open it for questions. Oops.